All right, hey everyone. Sorry for the little bit of a late start. I was trying to get 1080p going and it was not successful, so I'll have to try again tomorrow. Hi Stacy, good to see you. All right, so let's take a look at what happened in the markets today. First thing, I wanted to see if we got an updated number on this NAIM investment manager, but looks like they haven't updated it today for some reason. So we'll go on without that and let's see what's going on inside this market. All right, so SPY. A little bit of drama today. We did open high, but we traded all the way down, almost all the way down to the EMA 20 before recovering back up to the EMA 8. So really just a pretty flat from yesterday, down only 0.08%. So there is a lot of concern that at least from people who are typing into me or asking, what's going on, Kane? Why does it keep going down? Is it going to bounce? Because earlier in the day, I did indicate that bouncing like a up and down movement inside the markets today because of the gamma exposure that I saw. So it turned out that, yeah, it did actually bounce and recover. And it's just mostly directional until it was only that last half hour or so where it really started to recover up. Some other person also asked me, well, it doesn't seem like the gamma levels were all that helpful this week. So we'll go back and review and see if that was actually the case. It's definitely not my personal trading experience while using the levels. So we'll go back and review at least the things that I sent out to see if that would have been helpful for you guys. And then I did get some questions about what is gamma exposure? Why is it? Why do you talk about it? And why does it seem like it's something that you watch in the markets? So I'll go over that as well. So first, let me go into the Telegram channel. Again, there are people who are using my name, my face, my likeness, my video images of me to run through AI and unfortunately scam people. So watch out for that. If it's not coming from this YouTube channel or my official Telegram channel, then it is not me, okay? So let's go ahead and take a look at this week so far. Normally I do this on Fridays, but since someone made that comment, I just want to see how accurate we've been this week. Hi Tim, hi Illinois Grain Farmer. Can I trade SPY until 4:15 p.m.? Most brokerages nowadays will let you trade SPY and SPY options until 4:15 p.m. Yes, and you can always trade SPY, the underlying, in the after markets anyway. So you'll be able to trade the underlying beyond 4:15. Hi Frank, VIX spiked back up, and let's see. You're welcome, Steven. Let's take a look at VIX. A little bit. It is, so we are actually below yesterday's level, but yeah, today during the day when we were seeing most of the day it was SPY did trade down. Yeah, it did creep back up into that 17 to 18 region. So we're at the top end of that volatility regime. Again, like some people like to go 0 to 15 is low and 15 to 25 or 30 is high or medium. I like that 20 a little bit better just because that's more followed institutionally. But yeah, there is a change in behavior. There is a difference in behavior near 20 versus below 15. So we'll explore that in a little bit as well. So let's go over those gamma levels and then you'll see how helpful, whether or not they were actually helpful this week. And then we'll take a look at exactly what gamma is and why I use it inside when I evaluate things. So over here, we've got GEX on Monday. I said that it was overall bullish with a heavy concentration on 628 and 630. And then it was 630, 625, and 6300, 6325, and 6350. For the SPX. So let's see how that, I did not give it an update. So let's see on August 4th, where did we close? We closed at 631.17. So the 630 would have been the closest thing. It was a little bit stronger than gamma anticipated from the early morning. And so it actually traded a little bit above 630. If we go SPX, And the main thing is knowing that it was a bullish day. So, and then we closed here at 63.29 on the SPX. So much better a read on this on the SPX, where we said at 63.25 on that. Where is it? Over here, this spike right here is the one that actually got where we ended. So, I mean, I would say that was reasonable. Reasonable. Remember, we're never going to nail it spot on. You know, Gex is not going to nail it spot on, but it will get you in the ballpark. Okay, and very close, and within like a nice, reasonably tight range as well. Usually within $1 or so on SPY. If we take a look at Tuesday, I said that there was no clear indication from Gex or on the SPY, and so we were expecting a wishy-washy back and forth day, and you can see that there was a polar on the SPX, and then a big wishy-washy range on SPY, and during the day in SPY on Tuesday, we traded down and then we went wishy-washy. All right. Yesterday was kind of the opposite. We started a little wishy-washy and then we traded up, but then really we just chopped sideways. After 9 or 12 p.m. Eastern, we just started chopping sideways. So let's see how the gamma levels did yesterday. Similar to yesterday, exposure across a wide range of strikes, and then we're saying 625 to 630 on SPY, and 62, 65, 63.40. So this one probably busted through that, right? I guess not really. I mean, yeah, it ended up around, or it did go up as high as 632 and change, but we ended at 632, roughly 632 and a half, a little bit over that. See if I gave an update through the day. I was pretty busy yesterday, so probably not. Yeah, I did not. So again, it would have indicated that, hey, we're going back and forth in the upper range. So maybe a little less useful yesterday, but it did get a reasonably close. So at 630 versus 632 and a half. Again, not super close, but at least in the right direction. And then this morning, where I said, okay, we were favoring 635 on the SPY with 63.70 and 63.95, but we did also have a wide range of exposures over here. So that's been characteristic this week. We haven't had those really clear gamma pictures like we have had in the past. Like last week, very clear 625 gamma exposure right there to the downside. We had a very clear gamma exposure right there on the SPX. We had very clear exposures over here. So it's just a little bit harder to read, and it just means that there's a little bit less certainty utilizing those gamma exposures this week. And that's fine. Not everything's going to be perfect every time, and we are going to have to, it is an art. It's not a precise science. So this morning we said 635 was favored, 63.70 to 63.95, and then it shifted to 630, 631 later on. And then on the SPX, it was 63.50, 6,300 to 63.50, and we ended at 632.58. So again, about $1.50 above where we thought gamma would indicate earlier. So what's been happening is during that closing hour, there's been a lot of risk shifting inside of the markets. So people are repositioning themselves later on in the markets. And we do see that somewhat commonly. In the last hour or so, there's a lot of shifting. A lot of times that's already captured, that movement's already captured in the morning. And so we just want to confirm if that remains the case as we go into the close. In the case of this week, there's been some really significant changes towards the end of the markets. And so we still come pretty close though on those gamma levels. All right, so I mean, they're close enough for me to trade them successfully. I don't know, I guess other people, you probably need a little bit more time and experience. And as you watch me do it, and as you watch me in these post markets talking about these levels, you should start to get the hang of it. If not, at some point in time, I'll probably do some specific training on how exactly to use it. So for example, when we got up here on XSP today, let me show you guys how I used it today. Okay, I can't show you all the trades. So I gotta protect my members. So I've got to show you only my personal trades. Okay, so here we go. So XSP made over 100% right there. Actually, it should be higher. I did a 637, 636 put debit at 44 cents. So I made 56 cents here over 44. So that's over 100%. So let's see what that turns out to be. Calc, that would be 56 divided by 44. Okay, that's 127% that we made on that. And that was going into what? That was 637. And 636. Okay, so basically this was a play that this would stay below 636 for this day. And why did I do that? Because Gamma was indicating to me that I don't know if I have an exact picture of it. But we had, let me see if I can do this side by side. Okay, so we need equivalent levels here. So I don't know if you guys saw my video last week on how I get equivalent levels when I'm going across indices and SPY. So XSP, basically I will just look at the high of the day, the low of the day, come on. And then I'll line up those lines. So those two green lines should basically be at the same level. So it's a quick and dirty way of giving me the linear, basically linear regressing into levels. Okay. So basically I was counting on SPY staying below 634. And we had seen the 635 concentration right here, which we started above it, then we moved below it. So I was counting on that being a ceiling. And then later in the day, gamma exposure did start to shift downwards, but I made the decision while this still said 635. And that's why I got a little bit above 100%, right? I was able to get in below 44 cents. So basically as this rose up and touched that 634 level or 636 on the XSP, that's when I went into that trade. And so basically I'm just counting on that staying below, this bouncing down and staying below for the rest of the day. And that's exactly what happened. So that's an example of how I used the gamma inside of the SPY, SPX. And that's really, it's a way, that's how I use gamma always, even if I'm looking at individual stocks. So I can go over what gamma is and why they become important levels. So gamma has been good. I don't say that whoever emailed me and asked me, like, stated that gamma levels have not been accurate, but they've been less accurate. That's for sure. This week they've been less accurate, but not so inaccurate that you can't successfully use it to trade and make money. Okay. So let's see what you guys are saying. Uh, Hi Kay. Yesterday my SPX gamma helped me. Today I wasn't sure. Okay, yeah, sometimes it's harder to tell. I John checked out today and didn't trust myself on price going back to 632, which I had marked and bailed, but it didn't happen until the last 6 minutes. Okay, so you tried to use it and your instinct was right, but you didn't have the gumption to hang on to it. That happens. You'll learn. That just takes experience, time and experience, and then understanding when you're reacting out of emotion versus reacting out of the setup and the probabilities that are in front of you. So that'll come with time. Okay, so gamma. What is gamma? When we look at, just say, any given stock, just say Apple. Let me see. Let me think of one that I was on with Jack and Alex this morning. McDonald's was a great example. Okay. So when we look at McDonald's and we look at this technically, there is a limited amount of information that we can see here. Basically, we see price action and we see volume. Everything else is manufactured on top of that. So moving averages, things like that, indicators, that's all manufactured. And institutions, large institutions, they don't look at, well, they'll look at moving averages. Generally, the larger, longer ones like MA200 and MA50, MA90. I use the MA100 instead of a 90, or actually, this is 90. I use a MA90 instead of MA100. That's just some institutions will use 100, some will use 90. They're both pretty close to each other. I just use the MA90. So, what can we tell here? That we assume a lot of things like trends. We assume things like supply or demand based on where there is a lot of price action in the past. Okay, and those are not necessarily bad assumptions. Okay, so a lot of times, especially with large mega cap stocks, they are really good assumptions because institutions are looking at that also. Now, what we don't realize is that these days, especially since 2020, especially since COVID, the options market has exploded. Now, on any given day in the S&P 500, at least 40% of all the shares that are traded in a day are being controlled by options. Okay, so that means if we didn't have an options market, all the volume in the S&P 500 would suddenly drop down by 40%. Okay, that's nearly half. So the options market is very significant now, and we will see a time where it grows over 50%, and then it'll be super significant. So what's going on is that because options have become important, we have options market makers, and there's been a big volume of options being traded. What we see are two phenomena. Okay, two phenomena. Most people explain the first one as, oh, it's just psychology. People like round numbers. The first phenomena is where price action happens. Okay, so if I'm going to look at 300. Let me just put 300. Okay, I'm not going to bother making it super precise, but close enough. Okay, so 305, 310, 315, and 320. Okay, and I want you to notice certain things. Okay, well, let's go down also. 295, 290, and 285. Okay. And so let's take a look. And I just want to look at this 285. Did a price basically come and bounce off of it? And did it not happen again right here? And then let's just go down to 280 just for fun, okay? Did it not happen over here at 280? And then 285 right here, 280 right here, 285 right here, 285 right here. And then not a lot of price action happened at 290. So we hit 290 right here, reacted here, reacted here, reacted here, 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 here. McDonald's is kind of messy trader, but many times on 290. And then if I look at 295, yeah, same thing, 295, a lot of ceilings over here, highs on 295. And then over here, a lot of ceilings at 295 again. Okay, and then it pulled back to 295. Okay, so that was a lot. Now we take a look at 300. 300 is there a lot of action here. This was a bounce down off of it, a consolidation move up through it, then about a ceiling, a ceiling, a ceiling for several days over here, a floor. I won't call that a floor. That was probably the lower level. Okay, and over here we bounced off of it again, and here we bounced and consolidated off of it again. Okay, and about 305. If I do it at every $5 interval, I'm going to see a good lot of movement. And some are going to see a whole bunch, like this 305 to 310 area saw a whole bunch recently. And there was, I think that 285 saw a whole bunch also. So even more than the other ones. So the question is, why is that? How could I just happen to draw lines at every 305, every 5 interval and see a lot of price actually reacting to that level, right? And why isn't it just happening at 307.4 instead of 305? Why is it happening at 389.8? Or well, that's too close to 390. But you get my point. Why is it not happening at a random number? Why is it happening at a 5? And the answer is because most people will tell you it's psychology. People like round numbers. You know, where institutions are targeting round numbers. And the answer is no, 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 no. I'll tell you why. It's because if I look at McDonald's and I look at their expirations, especially their close monthly expirations, they're actually every $2.50. Okay, but if you look at every $2.50, look at this 310. Okay, look at the volume on it and the open interest, 2,000. Okay, if I get 307.5, there's only 300. Then I go to 305, there's 6,500. Then at 302.5, there's only 100. And then when I go to 300, there's 9,000. Okay, so what you're seeing is that, yes, there are those 2.5 strike increments that are available, but the option open interest there is very little. But if I go every 5, suddenly there's a lot. There's thousands every 5, but all the 2.5s only have a couple hundred. Right? So what that's showing me is that a lot of people, they're trading the 5 increments. They're not trading the 2.5 increments. And because we have these clusters of trading happening at these strikes, and these strikes are not happening at weird random numbers like 286.43, right? They're happening at 285. And they're happening at 290. They're happening at these round numbers. That is why price action reacts to these whole numbers, not because of random human psychology, because we like round numbers. It's because there is a lot of options interest in those specific strikes, and those options interest translates to shares being traded inside of the underlying market. Why does it translate to that? So one big secret that no one realizes, and it took me a little bit of time to realize it myself actually, is that when you're looking at this option chain, when I expand it to look at the whole thing like this across every single expiration and every single strike, when I look at that open interest column, guess what I'm looking at? I'm looking at the option market maker's entire book for McDonald's. I know their exact position. So we're saying, oh, normally people go, oh, there's 2,128 open contracts at 320. That means what all the buyers in the market have bought a total of 2,128 contracts. Yes, that's true. What people don't realize is that the options market maker sold every single one of those to all the market participants. That means the market maker is sitting short 2,128 contracts at 320 on August 15th. But they're sitting short all these other calls as well. All of these up and down the chain, okay? So when I look at the entire chain across all expirations, I know their exact positioning in their exact books. So my question to you is, if you knew a major Wall Street institution, you knew exactly what positions they had, and you knew exactly what positions they had yesterday and the day before and the day before and the day before, and then tomorrow you get to see the change from yesterday to today, would that be valuable information? And the answer is, you would know exactly what they were trading. So yes, that would be valuable information. As an institution, when I was trading institutional money, I was trading $200 billion a day. If I had that type of information, I could crush that other institution. I could milk so much money out of that institution. And what people don't realize is that a lot of people think that institutions trade against retail, and most institutions, the giant institutions, they don't even care. You're like ants. We're not even thinking about you. We're just walking all over you, doing our own thing. What those institutions are doing is they're either accounting on the overall economy, which is why to them, economics is important. It should be less important to you as a retail trader. But to those guys, it is important. And the other thing that institutions do is they feed off of each other. They trade against each other. And so there are giant gorillas like Goldman, like Citi, like JP Morgan, like the firm that I was at, Premco. I was always the 800-pound gorilla in the room. It didn't matter, even if when I was facing Goldman or if I was facing JP Morgan, I was still bigger than them. So we feed off of each other. Sometimes we work in tandem mutually, so we both benefit, but most of the time we're in competition and we're trying to eat each other's lunch. And that's why you want sharks on Wall Street. That's why Wall Street has this cutthroat type of reputation, because we're just trying to ream the other person, trying to get money, just wring money out of the other person. Okay, so if I knew, for example, if I was Goldman and I knew JP Morgan's book on a certain position, even if I didn't know their whole book, if I knew a portion of their book, I could use that information to start squeezing them and making them really uncomfortable, force them to make a certain type of trade, and then I could benefit from that. So we would actually try to piece together other people's other institutional books, because we could get clues, because we would get offers wanted in comp, bids wanted in comp. Basically, institutions saying, hey, I want to sell these things and I want to compare. I want to see what everyone wants to bid for them. So please give me all your give me all your bids. That would be a bid wanted in comp. Or give me all your offers. Hey, I want to buy something. I'm trying to source something. So I'm going to send out a list to 10 or 20 large institutions. Hey, if you have these, offer them. What will you offer them to me? Okay. And so if I get an offer back, I know you have a position in the, okay, because you can't offer me something you don't have unless you're going to go back and go and borrow it or buy it from somewhere else just to sell it to me, which is kind of unlikely. So if you have an offer, if I do an offer wanted in comp, then I know you have that position. I might not know your size, but there are other ways for me to get a clue as to how big your size is. And then same with bids wanted in comp. Okay, so then I'm trying to sell something, and if you're willing to buy it, especially if you're willing to buy a weird lot or an odd lot, that gives me an idea that you have a position in that as well. So there are ways that institutions game each other in order to figure out what the other position is. And if I can piece together enough for me to make it worthwhile and try to squeeze you, then guess what's going to happen? Wall Street doesn't care. They're going to squeeze that other institution and try to milk as much money out of them as they can. Okay, so realizing that this is the market maker's book, well, we're no longer a giant. Right? I'm not the 800-pound gorilla in the room anymore, and I can't just walk around squeezing people. Okay, I have zero ability to squeeze the market maker, but I can understand the market maker. I can understand the market maker's position. I can understand their psychology. I can understand their business model, and I can understand their policies and their methodologies. If I understand all of those things, then I can predict what they're going to do. So first of all, if I understand their business model, I understand their policies and procedures, then I can predict their behavior. The only thing that's missing is their position. And once I know their position, which is actually right here, right in front of us, all those open interests. Once I know their position, then I can understand exactly what they're going to do under certain conditions. And then all I have to do is find out what the current conditions are, and then I've got a good chance of knowing exactly what they're going to do. Sometimes that's not meaningful, but other times it is meaningful because I can find conditions in which the McDonald's market maker is going to be forced to move a lot of underlying stock. And if I know that, then I know that if their buying and selling becomes significant, that's going to push the underlying market up and down as well. And then I have a chance to front run that and make a bunch of money. That's the premise behind my service called Gamma Pockets, is understanding that we're looking at the market maker's book. And by market makers, I'm saying all the McDonald's market makers smushed together, because there's going to be more than one, but they all behave the same way. They're all market makers. They all have the same business model. They all have the same policies and procedures. They all hedge themselves the same way. So if I know that, then I know that if the market moves in a certain direction, they're going to start changing their hedging, changing the amounts of their hedges. And by knowing that, I can say, okay, well, if this market event happens, then they're going to move X million dollars worth of shares. And if that is a significant number versus the number of shares that normally trade on McDonald's, then I've got a trade going, okay, because that's going to start pushing the underlying stock around. So is this recorded? Yes, it is recorded. Let's see. Let me see what you guys are saying. McDonald's looks like it's in a gap. We'll take a look at that. Strike spread distance. I'm not sure what that means. Wouldn't that be because of options prices? Sorry, I missed when you asked that question, so I don't. Option strike interest. So a lot of people confuse option interest and gamma exposure and the risk. Okay, so I gave a perfect example of it the other day, where we found a great example. This is going to be harder on McDonald's probably, but look at it. Okay, so if you just go by option interest and you say, hey, look at this. There is 1,111 open interest over here. They must have a lot of risk right here. Okay? And so when I go and I look at the risk that they have right here, that is calculated to be about $176,000, which is not that much, okay? But let's look over here. There's only 243 open interests, 1/4 of the open interest that we have right here, okay? So you would think by open interest, I have 1/4 the risk if all you're looking at is open interest. But guess what? No. They have over $1 million worth of risk right here. Okay. They only have 100,000 risk over here. They've got four times as many open interest right here, but 1/10 the amount of risk as they do over here. I lost it right here. Okay. So no, open interest is not equivalent to gamma exposure. It is not equivalent to risk. And if all you're doing is looking at open interest, you are making a huge mistake. You're going to lose a lot of, you will make money sometimes. And other times you're going to make a really, really, really bad mistake. People ask me that all the time. Kane, can I just like open up? I don't need your gamma exposure. I don't need your gamma stuff because I got open interest. I'm like, okay, good luck. Power to you. We'll see what happens. If you're actually going to trade off that open interest, good luck. Okay, because that is not the market maker doesn't care how many contracts. I don't care if you said, Kane, I've got 100 contracts of McDonald's. Great. That doesn't tell me anything. I don't know if you're at the 400 strike. You got 100 contracts that you paid 5 cents for. Okay. You spent $500. Or you have one contract at the 200 strike. Oh my God, you spent $10,000. Where do you have more risk? You tell me. Okay, so the open interest is completely meaningless by itself. You need to know a lot more information in order to translate it into useful information, useful tradable data. Okay. Monthlies is better than weeklies based on a similar idea, meaning the number of open interest at around each strike, I think is what you're saying. And generally, yes, that is true. But when we're talking about gamma exposure, the most useful information is total gamma exposure. That's across the entire chain, across all strikes, across the entire chain, and that's aggregated data. And I'm working on releasing software for everyone that would be made available to everyone that would help you visualize that. So this is just a prototype. It is not close to being in production yet, but it is the beginning of being in the works. So if we were interested in McDonald's, we would do something like this, and you can see, hey, look, there's a lot at 305. Okay, so we just passed that today. And then there's total, we're in positive gamma territory. We don't see any negative, right? We don't see any put gamma over here. That's really interesting to know. And then net, we've got $40 million of exposure. That means for every 1% move in McDonald's, the market maker could lose or make $40.8 million if they don't hedge themselves properly. That's a lot of risk. You don't want this to move like, oh my gosh, we went to 310 today, I just lost $40 million, right? That'd be a terrible conversation to have with your risk manager. So that's the most useful number. The second most useful is if we break it down into expirations. So if I go over here, and this is my other tool, and I go to McDonald's, then I can see that in August 15th, okay, yes, I do have a lot of exposure at 305 and 300. So that is the majority of the exposure right here. So here we've got, what is that, about 2, what is that, 2.5 million? And over here, it's showing me that overall at 305, I've got about 10 million, okay? So nearly a quarter of all the risk at 305, it's going to expire on August 15th. So if all of this expires and goes away, and assuming no reinvestment into McDonald's, which is not a good assumption, but assuming that happens, and then we go to mid-September, what we see all of a sudden is that we have by far the most exposure right here at 320. The gamma picture shifts. So by expiration, what we see is that, oh, actually, in the short term, we were expecting 305. We went past it today. And on a 1 month term, we're actually positioned to move up to 320. And then for the market maker, as it gets closer to 320, the price gets, remember, they sold a bunch of calls. So if for every dollar this moves up, they're going to owe whoever bought the call more and more money. And it goes up parabolically as we approach 320. So what's going to happen is for each dollar this goes up, the market maker is going to buy shares, okay? Because if they have to deliver, just say 100 shares, because at 320 that's going to be in the money, then they would rather buy it when it's down at 305 or 310 than pay 320 for it and then deliver. Okay, so that's the idea behind hedging. It's like I got to buy more and more. The more likely it is I'm going to have to pay out on these or actually deliver underlying shares, the more shares I need to buy up at the lower price, and so I'm not paying full price and then delivering, because then it's maximum loss for me if I wait for this to expire in the money and then I have to deliver and buy market value shares, then I'm going to experience a giant loss. So I need to start buying those shares a lot earlier so that I don't suffer a giant loss. Okay. In fact, if I do it early enough and I do it right, I will still make money even if it hits 320, because I charged a premium on those 320 strike calls. Remember that. You didn't buy these 320 calls for nothing. You might have bought them for, say, $5. So in which case the market maker is covered, even if they still make a bunch of money, even if it lands at 320, because they charged you $5 for that call. Okay, so the market maker is playing this game of probability. How likely it is, am I going to have to pay out on all this exposure that I have here? I've got a huge amount of exposure right here, so I need to hedge that very carefully. I'm going to be watching that the most closely versus all of these. I care about these as well, but not nearly as much as I care about this one because of how much exposure I have. And so the market maker is playing that game of finely balanced game of, how do I keep myself protected, and so that I keep making money collecting the premiums or the bid ask on every strike, on everything in my entire options chain. Okay, so if I expand this, everything over here, right? And so that's why total gamma matters more than short-term individual gamma, because they're going to hedge their entire chain. They're not only going to hedge, next week, they're going to hedge absolutely everything because there's exposure. They're going to be at risk everywhere on every expiration and every single strike. Okay, so that means that market makers hedging activity, they hedge using the underlying stock. So that means they're going to be buying and selling a whole bunch of McDonald's. And it's that hedging and buying, because what we know now is that a lot of times it's making up 40% of the volume. So if I know how many millions of dollars worth of shares they have to buy, and I know now that McDonald's is trading however many millions of shares per day, I can figure out what percentage on a given day that the market maker's hedging activity is. And if it's only like 1%, then who cares? It's not going to move the underlying. But if it's 10%, 20%, 50%, 80%, you bet your butt that's going to move the market. And most institutions, they don't want to be a large percent of the underlying volume. They're doing buy campaigns. So they'll buy right here, then they'll buy right here, then they'll buy right here, and they'll buy right here. And maybe 10 times from now, like 10 allocations, they finally bought their entire position. But the market maker doesn't have a choice. They can't do that. If they are exposed by $40 million, they need to go and buy $40 million worth of stock immediately, the same day. So it doesn't matter to them if they're driving up that price, because they need to cover themselves. They need to cover their butts. They don't have the luxury of spanning it out and waiting for a couple of weeks and waiting for a pullback and all of this stuff that other institutions can do. So the market maker, they have to transact that day. And so if I know they're forced into a position where they're going to transact a significant percentage of the day's volume, then I know they're going to move the market. And so what we saw right there was that we were what are the lines before I did all this? There we go. Okay. So just say I know that they're going to have exposure up to 320, and I see this market moving up towards it. I know that they're going to have to buy X number of million. For every dollar that moves up, they're going to have to buy a certain $1 million worth of shares. And that's going to contribute to it moving up and becoming a self-fulfilling prophecy where it goes up to 320. Okay. So there's this hidden force inside of the markets that you just never see on this chart because it's not there. If you don't, because this is an equities chart, it's not an options chart. So it's never going to show up on here. Now, what I'm working on is software. That same software is going to give you not just the view that I showed you. Okay, so not just this, but we're also going to give you a visualization that looks like it's going to look like this. Oops. Okay, and so now we throw important levels. Like we know that the largest concentration of gamma on McDonald's is right there at 320. There's a call wall at 310 right there. What does that mean? I'll explain it once all the software comes out, but basically that indicates short-term resistance for me. Okay, so I'm not going to expect this thing to go straight to 320. There's a call wall right here. Look how many times over yesterday we hit that call wall. Yesterday before pre-market, then twice for a very long time towards the end of the market, then today right at the open, we hit that call wall and we weren't able to get above it. So once that call wall breaks, it's going to be a little bit of a rush towards that 320. That'll be our expectation. Then we have this transition zone where the gamma goes from positive to negative. So I've got this right here. Remember we saw that everything over here, look, everything is positive gamma. There's all green bars. There's no red bars down here. And so if I do SPY, different, right? There's some red bars, there's some green bars. There's some down, there's some up. Well, if we see the underlying McDonald's stock go down below 300 or 295, we'll start to see negative gamma come in. And so we'll start seeing those red bars. Maybe we'll have 0 green bars and all red bars. And then it'll be basically a straight line down to 285 if that happens. Okay, that's what gamma is telling me. Right? So there's a lot of useful information that comes out of understanding exactly how the market maker works and what their actual influence is in the underlying stock. That a lot of people just don't know and don't understand and don't even consider. So the market maker is actually a very powerful, it never was a few years ago. Okay, so before COVID, everything that I'm talking about would have been a giant waste of time. Okay, but the options market exploded after COVID, and market makers are becoming more and more significant, and their actions inside the underlying are starting to push around the stock. So that is what gamma is, and that is why I couldn't answer that in that email. It took me almost an entire session to explain what gamma was. There's no way I could reply to that in an email, and hopefully that was useful and helpful education to you guys. Eye-opening on how the markets actually work. So let me see what you guys are saying. I lost the chat again. Moving too many windows around. Okay, let's see. I entered a SPY trade today, 64 cents, 1-day expiration, 629 to 630 call vertical debit. What price should I exit tomorrow? Tasty has the default set to 50 cents. So Tim, unfortunately, I can't give personal advice and I can't give opinions on trades that I didn't publish. So because I'm just a publisher, I'm not an advisor. So I can't say that, but I would evaluate the probability of SPY staying above 630 and you're expiring tomorrow. So, so one thing that you could do is you go into option strat and then you say you have a call debit spread, correct? If I'm, yeah, okay. And so you have a SPY tomorrow expiration, 629, 630, and you paid 64 cents for it. So you're already up. You're already up a good amount. So I'm just going to make up numbers because the actual numbers don't matter. Only the spread between them matters. So you paid 64 cents debit. Okay. And so what we want to see is tomorrow morning, assuming no price change whatsoever, okay, right at the open, okay, then what we're saying, and no change in volatility, you should be able to have roughly $21 in profit. So you should be able to just sell it in theory at about 85 cents. Okay. If you wait a little longer and it never goes below 630 and you wait till the end of the day, then you can get to that max profit of $36. All right. So that you'll just have to evaluate. So if I was in a similar trade, I have to be very careful how I talk about this and make sure I don't fall into advising. But okay, if you're in a vertical and you're in the max profit zone, okay, time is working for you. Time is working for you. I showed you guys that, I think, a couple days ago when we were talking about debit spreads and time. So as time goes on, you see my price stays the exact same, but I'm getting more and more profit until I hit that maximum. Okay, so if you're in this max gain zone, time is in your favor. Volatility is against you, but look, even if it goes 3x, it's not really going to affect you that much, right? You're going to go from a 85-cent contract value down to 82-cent contract value. Big deal, okay? So I wouldn't be thinking about volatility right now. I'd only be thinking about time and the position. Where is the underlying price relative to my max gain zone? As long as I'm comfortably up here, I wouldn't even care. I would just let time work in my favor. If you start seeing it creep down towards 630, then you got a decision to make. So somewhere between 630 and a half, 631, you've got a decision to make on whether or not you want to keep it and risk going down here, or what are the chances and what are the probabilities of it bouncing and coming back here. There are a lot of tools that can help you decide that. There's opening range. There's the gamma levels, SPY, SPX gamma levels that hopefully you'll get from me in the first half hour to hour of the markets. But otherwise, I would only care about the passage of time and whether or not I start to get into a less comfortable situation where I'm closer to the edge of my max profit zone. Okay, so that's as much as I can say about that. I'm skating the edge over here. That's a lot to wrap my head around. Very interesting. What an advantage you're providing. You're welcome, Bernadette. Yeah, and there's the replay. You can watch it over and over again. Hi, Isby. Oh, you made it. Oh, wonderful. So hopefully you caught all of the explanation, but if not, you can rewind and check it out. Yeah. Okay, great. I should find that replay. I just got out of Apple and Amazon, most likely too early as I was deep in the money and the risk quickly dissipated. Yeah, you just need, how far in are you, and are you far enough in for comfort? And then if price drops, is it still in a comfortable range? or are you starting to get threatened by that in that max gain zone? Those are the main consider. Oh, and then if you're, of course, if there's a lot of time left, then you need to be a lot further into the max gain zone in order to be comfortable, right? So depends on how much time you have left in your spread as well. Okay, we didn't really talk about overall markets, but hopefully you got a good lesson and learned quite a bit about how markets operate, if not all the details of the gamma. I think the main takeaways is that there are reasons why, other than what people are telling you, other than price action, why prices are reacting to certain levels inside of the markets. And there is a force, a hidden force called the options market maker that is pushing these options prices around. Unlike what most people say, oh, the market maker is manipulating the prices so they don't have to pay out on these calls or whatever. No, wrong, 100% wrong. The market maker does not have nearly enough capital or the risk appetite to actually, they could lose, if they were unable to manipulate the market and they're trying to manipulate the market, they would lose so much money. And it's not worth losing that money just to save on paying out on some of these contracts. It doesn't make sense. The market maker is hedged, so they literally don't care where the markets go. As long as they're hedged for that situation, they're perfectly fine. So that McDonald's, if McDonald's goes up to 320 and the market maker is doing their job right, they're not losing a bunch of money because they sold a bunch of calls down here at 307. They're not losing money. So they're not going to try to manipulate when we get to 320. They're not going to try to suppress and push the prices back down. That is not what happens at all. Zero. Okay. So don't listen to the people who are telling you that market makers manipulate the markets. What is happening is they're hedging. And guess what? If we hit 320, they don't need a hedge anymore. And if we bounce off of 320, guess what? They're going to let go of some of their hedges. And that's going to drive the prices down further away from it. So if you're a conspiracy theorist and you don't know how market makers work and you don't understand that market makers hedge themselves, then it's going to look like that they're manipulating the market and trying to force the price back down. But that's not what is happening at all. Okay? So we need to understand exactly the truth behind how things operate. And that way you can use that phenomena to make money rather than sit here and have conspiracy theories and get mad and pissed off. Oh my God, they manipulated the market. My call was making so much money and then I lost money and I got manipulated. It's so corrupt. No, you just don't understand how the markets work. And the markets reward people for understanding and for knowing things that other people in the market don't know. Okay? So you rightfully lost your money. If that happens to you, you buy a call and you see it bounce back off of a certain level and you're yelling and raving that you got manipulated and you lost money, the answer is no. You did not know or understand what you were doing inside the markets, and the markets punished you for it. And they rewarded the person who did understand it, and they took that money away from you and gave it to them. Okay, that's how markets work. If you know something that other people don't, or if you understand the way something works that other people don't, then you're rewarded in the markets. Nancy Pelosi knows a lot of stuff that nobody else in the market knows, and she gets paid a lot for it. Now, we can argue that that's illegal for her because she has an advantage in information. But the fact is, the market doesn't know about those laws. It just knows that she knows something that other people don't, and she gets rewarded very, very handsomely for it. Okay? So you need to know and understand how markets work if you want the market to consistently hand you money, because it's going to reward you for that knowledge. And hopefully these sessions are helping you increase your knowledge and therefore get more rewards from the markets. Okay. Let's see. Got threatened on SPY diagonal, took a small loss, SPY opened much higher, and then sold the call. Yeah, it happens sometimes. So again, the market didn't do what you thought it was doing, so you knew the wrong information, and therefore you lost a little money. Or called out by the president to resign. Yeah, there's been a lot of that lately, huh? Okay, Uh, oh, thank you, Esbe. I appreciate that. Thumbs up if you're learning something. I do appreciate them. Okay. All right, guys. That's it for today. It's probably a lot to chew on. If you need to replay it, replay it. It's always going to be available for you. All right. Have a wonderful rest of your evening, and I will see you guys tomorrow to close out the week. All right. Bye, everyone.